Good afternoon. I would like to thank you all for joining our video conference today, from Athens to New York, to London, to Geneva, and many other cities. The Harvard Business School Club of Greece has a long tradition of addressing the important issues from the global crisis of 2008 to the Greek debt saga to the European Union structural challenges. These days, in everyone's mind, there is an urgent question: how will the economy of our country fare following the COVID-19 epidemic? Is it going to be a fast recovery or a prolonged recession? We know the current published European Union projections for the Greek GDP are negative 10% for 2020 and then positive 7.9% for 2021. For the budget deficit for 2020, we have negative 6.4% and negative 2% for 2021. The unemployment will reach 20% for 2020 and then 17% for 2021. The debt to GDP ratio increases from the current 178% to 200,000 in 2020, and then to 195% in 2021. But in order to comprehend and to systematically evaluate the prospects of the Greek economy, we need to understand the impact of the global economy. The potential decoupling of China and the US in 2020 might send negative waves on a global scale. The status of the European economy and the emergency measures to address the impact of the pandemic, also Germany's growth and Italy's debt and political instability are significant factors which will affect the course of the Greek economy. Greece faces three key challenges: an investment gap. We need more gross fixed investment, low competitiveness, and high levels of public debt and NPLs. Following the successful handling of the COVID-19 pandemic, which are the government actions and measures to overcome this economic crisis? Which additional actions in case of a second wave of epidemic must be taken? We are honored to have here today three distinguished panelists to address few of these issues. Luigi Buttiglione, the highly acclaimed global economist, will address the EU economy, being advisor to major hedge funds and financial institutions. He also possesses a deep understanding of Italian economy and its complex political dynamics. George Tsopelas, the head of McKinsey, and Vassilis, Antoniades, the head of BCG, both Harvard Business School fellow alumni. They are both advising the Greek government, and they will present their views on the Greek economy and on the specific industries. For example, the rebound of the tourist industry that the Prime Minister just talked about, the evolution of the energy sector, and the status of the banking industry, and its potential recapitalization if it was required. I would like to personally thank the three panelists who accepted my impromptu invitation and will enlighten us here today. I would like to start with Luigi Buttiglione. Luigi, which is the impact of the decision of the German Constitutional Court addressing the ECB quantitative easing? Also, we have several programs from ECB, the 750 billion Pandemic Emergency Persons Program, the ESM loans, the SURE program, and the potential funding of the Recovery Fund. How this will affect the European economy and Greece in particular. Luigi, thank you.
Thank you, Stelios, and hello, everybody. Thank you very much for the invitation, and nice to see you in a direct or indirect way. This is our new life here. And maybe to put things into perspective, shall I maybe start with a global perspective, Stelios, and then go into these three specific questions, which of course are very punctual and very timely. I'd just like to put things into context. Maybe now it's clear, but I think it's good to remind that what we are seeing now is the deepest economic crisis probably that we have seen, but that we have on our economic records. I would say really we have to go back to the 1929 early 30s episode to see something of similar depth, although in terms of really deceleration of activity, what we have seen and coordination, what we have seen in the last couple of months is absolutely unprecedented. Just to make an example, the drop of industrial production in the US, so not necessarily the most affected area, has been in April the deepest ever. So since we have records, and the record starts in 1919. So it's just to give the dimension of what's going on. I would say rather than a recession, also going to your question about the duration of this episode, I would not call this a recession. I would call it an economic crisis. And I explain that. A recession is something which is more similar to the V that everybody was talking about, at least until a few days ago. So it's really a deep contraction, but followed by an equally steep recovery of activity, taking you basically back to your trend, the trend where you were starting from, in a relatively short period of time. A crisis, and I think this is the kind of episode we are seeing now, is an episode when there is some persistency of the downturn. If the persistency become excessive, then we go into a depression, which is the episode 1929. But I would say that what we are seeing now, for a number of reasons that I'm happy maybe to tackle during the Q&A if there are questions, is not going to go away so quickly. So if you want, going also to the forecast that you were pointing at, not only I share them, but actually I'm even more pessimistic on a global scale, but also what I think that we are not going to go back to the same level of activity that we were having at the end of 2019, before probably the end of next year, so 2021, which is a substantial period of time. And this is extremely important because this means unemployment, this is deflation risks, and so on. The problem is that also while the shock is symmetric, in the end, quote unquote, everybody has had this kind of virus, but this is not affecting the world in a similar manner. I would say, you know, I'm a fan of your new government in Greece. I would say there are some countries which clearly have reacted better than others. Greece is definitely one of them, there is no doubt. Unfortunately, most of the biggest countries have not reacted that way. Say my country, France, Spain, the UK, the US, Germany in between. But so on a global scale, not everybody has reacted in the same manner. So not every economy is going to be affected in the same manner. Also because for two other factors, because there are some economies which are, say, a larger buffer in terms of wealth or in terms of low debt. Think about Switzerland, for instance. It runs high on both regards, while my country, unfortunately, runs quite low on both regards. So it's a country which has depleted a lot of wealth in the last years, and it has already a very high debt. So it has very low abilities to react to this kind of shock. And the last thing I would like to highlight is that the reaction is also linked to, and now I get closer to your questions of the German court and so on, and Europe. And there are some areas which actually, because of their institutional setup, are not as strongly suited as others to respond to this kind of event. So a country like the US, although clearly they've had the worst possible response to the virus, which we've seen globally, still at the same time, the other country is a country which issues a reserve currency, they can enjoy a very strong coordination between fiscal and monetary policy, so they are well suited to react to this kind of episode. The Eurozone especially is still a project which is not far from being finalized. It's still just, and I use the word just to say it's just a monetary union without all the other necessary union. It is not a fiscal union, it is not a banking union, it is not an economic union, let alone is not a political union. The lack of all these unions make the response to this kind of events extremely weak compared to a normal country like the US, but even the UK or Japan. So there is a lack of coordination between fiscal policy and monetary policy. There is a differentiation of the response of fiscal policy in the various constituencies, in Germany, in Italy, in Greece, in France. And the institutions are not really strong enough to give what we need at this time. And unfortunately, the case that you mentioned, for instance, the German Constitutional Court comes at the moment when there is one country which says, well, you know, one of the key institutions, which is the European Central Bank, actually maybe is breaking the treaty and the laws in our constitutions. And of course, this means that you jeopardize the credibility of the institution. And I'll come back to that in a second. So all in all, I would say that unfortunately, I see the Eurozone as the canary in the mine in this already quite compromised global environment. And unfortunately, from a personal standpoint, I have to say that Italy, my country, is the canary in the mine in the canary in the mine, because in this kind of weak institutional setup, this crisis hitting Italy when it has a particularly weak government, I would say comparable to the Greek government you had before the current one, and starting already with a very high level of public debt, a very low level of growth, so an extremely fragile situation, an extremely unstable situation. Let me go now to your questions. I think that my take on the German Constitutional Court is that not necessarily prevents the ECB to do what they've been doing in the last few weeks. So a substantial, I would say, correct monetary expansion of liquidity, because in the end, the Constitutional Court has no direct impact on the ECB. But there is a link, which is, of course, it's the Bundesbank. And the Bundesbank responds both to the European institutions, so the European Court of Justice and the Euro system, the European Central Bank, but also to the local institution, which is the German Constitutional Court, the German Parliament, and the government. So it's a little bit in between. And I think the ruling of the court, which I would say has some justification, is just something crazy, which was put out by the court, I think risks to not really to prevent the ECB from doing what they're doing, but to make them a little bit slower in their reaction. We shall see what will happen, especially at the June meeting, but it's possible that it will make the policy a little bit more of a compromise than it was, for instance, when they acted in March, when they really did the right thing and they put in place a substantial 750 billion expansion of monetary policy. We shall see. I don't think it's a decisive event, what happened with the Constitutional Court, but just symptomatic of the overall malfunctioning still of the overall European setup. As to the common fiscal response, now I go to what happened yesterday with the Franco-German proposal. I would say this is also really what is missing now, more than monetary policy, is common fiscal policy. As I said, so if you want, you can say that the ECB is still the main guy in action on the European scale, because there is very little common fiscal policy. By the way, we should not forget that despite calls from the beginning, I remember we were discussing these things even when I was at the Bank of Italy until 2000, when the Eurozone project was launched, we were complaining because there was no fiscal policy accompanying monetary policy. And in the good times, you don't realize that. You think everything is fine. But in the bad times, you realize this is necessary. So the attempt yesterday by the Franco-German proposal, you mentioned the other pillars of this common fiscal response, the ESM, the SURE, the leveraging up of the European Investment Bank funds, and the reconstruction, the recovery fund, which is part of the Franco-German proposal yesterday, I would say they are quite insufficient. Altogether, they are small in size. They look like enormous, because for a big economy, it's easy to speak about billions or trillions, but then you have to see in practice what they mean. And I don't think they are enough. Take, for instance, yesterday, if you start from the ESM, I would say that very few countries, if any, will take it. Spain has already said no. Italy has already said no. Greece definitely probably that doesn't, I'm not sure even they need it, but I would say that it doesn't seem like there is a stigma attached to that. So these 250 billions most likely will not be used. The SURE it's useful, but it's very small. 100 billions for a 13 trillion economy is definitely extremely small. And the European Investment Bank leveraging is still very unsure. So for the time being, rather than 250 billions, as in the hopes at the beginning, it's still 25 billions. So we still have to see if it happens. And to conclude with the Franco-German proposal, well, it is true it's 500 billions in principle of transfers, but actually the net transfer are going to be much smaller than that, because basically almost every country will get some of the funds. I would say the net transfer will be in the region of maybe 100 billion. Again, it's a very small amount. So there isn't, if you take Italy, because this is basically based on the leveraging up of the European budget, so Italy has to contribute according to its capital keys about it will contribute about 6.5 billions per year for the next 7 years. So in the end, they will contribute for about 2/3 of what they are going to receive. They will receive about 100 billions, which is good. They will receive it maybe upfront, but in the end, the net contribution will be maybe in the region of 2% of GDP, nothing which can really make a difference. So it's true, it's a first attempt, it's a first movement, it's useful, it's not a waste, and then of course there are other details. I'm happy I don't want to go too long, but in terms of conditionality and so which makes it certainly not a game changer, I would say.
Luigi, I would like to thank you because it is important for the Greek economy, the impact of the European measures, and we all follow very closely the economic and political dynamics in Italy, which also affect our country. Thank you very much, and we'll come back with questions. All the attendees have the right to, and they would love to potentially ask questions, so we will address questions in the end. I would like now to go back to the head of McKinsey, George Tsopelas, and I would like him to present us the views of McKinsey on the specific industries in Greece and on the Greek economy. Thank you, George.
Thank you very much, Stelio. It is a big honor, both for me and as well for the McKinsey, to be here and address all this distinguished audience. We will be speaking in the next 10 to 15 minutes about Greece, trying to share a relatively and reasonably optimistic perspective on the country. There are 4 reasons why I feel relatively and reasonably optimistic about Greece. The first reason is because we believe that most likely the GDP drop will not be as bad as the EU and the international forecast suggest. We believe that, assuming that there's going to be a moderate tourism recovery and that we're going to have a strong magnitude and impact of the different measures, we are looking at a recession of 5 to 7%. 5 to 7% one thing to remember is that this is going to be vis-a-vis last year, but the baseline is not last year. The baseline was last year plus what it would have happened, 2.5%. So essentially, it's much bigger. But based on 2019, we are talking about this. This is a much smaller number compared to what we have seen. The second reason we feel cautiously optimistic is because there are good news from the banking sector. The preliminary estimates are suggesting that despite the profitability pressures coming from new NPEs, the system will not require any new recapitalization either in 2020 or in 2021. So the system remains robust and core tier 1 stays above 14% in both years. There is an issue with DTC given the negative profitability, particularly in 2021, but there are ways to handle that. The third reason is that despite the very important hit that several important sectors have received, there is strong measures that are taking place as we speak that are both at the level of the sector as well as horizontal measures that have already been taken and new ones that will basically be happening as we speak that are very, very close to what the country needs, and the impact is already starting to be visible. Last but not least, the funding of this program, which is a 24 billion program, is challenging but is feasible. And we can basically say that commitments the government has made for tax and things that have already been legislated are eventually going to be honored. Also, it seems that there is a good probability that the public investment program will also be honored. So let's look some of the facts that are supporting this for reasons why we have a reasonable optimism for the country. We spoke about GDP. At the very end of the day, and assuming that there is no second lockdown in Q4, there are two key parameters. The one is that the degree of tourism recovery, and the second one is the magnitude and the impact of the state measures. What you see here on the right is just a depiction of that. So if you assume a moderate tourism recovery, which is 50% of the proceeds that we had last year. Last year, we had 18 billion of proceeds, assuming that these proceeds this year are going to be 9 billion. And assuming a program of 20 to 24 billion, which includes the 10 billion of already existing measures, the 7 billion of measures that started being announced today, plus the state guarantee program, 2 plus 5. Here we are taking a range of 20 to 24, assuming that there might be a range in the absorption of the state guarantee program. And you see here what the resulting rates would be. 5 to 7% is the scenario that we could hope to see. The second good piece of news is coming from the banking sector. The banking sector will definitely have an uptick on NPEs. Here we did an analysis bottom up, going from different sectors and different asset classes, and came up with an initial hypothesis that we're going to go up by 10 to 14 billion. We will be collecting 2 or 4 of those, so we will be having a net flow of 9 to 12 billion, of which 0 to 3 are going to be recognized in 2020, and 9 to 12 are going to be recognized in 2021. The reason this is happening is because of the moratoria that are happening for 2020 in terms of the recognition of these NPEs. This essentially means that the system will have to incur provisions that are in the range of 7 to 9 billion. Next question will be, okay, if this is the 7 to 9 billion of provisions, what will be the impact on the profitability position and the capital position of the banking sector? Let's have a view about 2020. 3.5 billion was the PPI for 2000 pre-provision income. Then we will be having some changes and some decrease and some new lending coming up. And then we are going to get the 3 to 4 billion of impact of provisions for 2020. And we will end up with a marginally negative position. With that marginal negative position, I don't think we will be having a DTC issue. And if you translate on the right-hand side of the page what that means for the capital adequacy of the system, you see what it is. So we are going down from 16.2% down to 15.6%. So the system is robust. Looking at 2021, as you see on the left-hand side, we are going to be having a PPI increase coming both from operation as well as new lending, but the provisions are going to be bigger. Therefore, the loss of the system could be material. up to 1.5 billion. But even if you look at that and you take it on the right side, you will see that the core tier 1 is just going to go from 15.6 to 14.5. So even in that situation, the system is robust. That calculation has also happened bottom up for each one of the systemic banks, and all of them at different levels are passing the yard. The third point is related to what we are doing as a country to address the problem of different sectors. As I said before, important sectors such as the ones that you see here had major drops. For example, airlines lost 50 to 60% of the demand full year, and that means that they have a gap vis-a-vis last year of $500 million to $0.7 billion. And this is 1.9 to 2.7 times their position last year. So it's almost 2 to 3 times. 2 to 3 times the damage that happened this year in terms of the pre-tax cash flow is basically 2 to 3 times as much as it was last year. And you see here what happens at the airports, ferries, and electricity and oil. What do we do as a country for those? We have been asked by the government to support them in the last couple of months, looking at the number of sectors such as the ones that you saw before. We are also going to be working on pharmaceuticals, on construction, and later we're going to be working also on hospitality. What we basically did there is, beyond the analysis, came up with the following program. There are going to be two sets of measures. The first set of measures will be from March up until June. For 4 months, there is going to be compensation for 4 months. And then there is going to be compensation for the period between July and the end of the year. The reason we are cutting into two is not only for time critical elements, but also because we do not want to have assumptions on the basis of which we are paying any compensation. We need to have almost things not exposed, but not ex ante, but exposed. So the first element is the time element of the support package. The second part of the support package is its pillars. For each one of the sectors under investigation, there are 3 types of measures. First, they receive the money for the public service obligations. Secondly, they receive grants or type of direct economic support, which is calculated on the basis of the impact from their P&L on their cash position. This is happening in an equitable way between sectors by basically trying to give similar percentages of what the damage has been between 2020 and 2019. And finally, you have a set of measures which are not related to direct economic support, but they are related to liquidity, such as state guarantees or other liquidity measures such as payments and deferrals. The last part is coming with some strings attached. So 2 programs in terms of timing and 3 different pillars. These programs are now being decided within this week and next week, and they will be announced as there have been today some announcements of programs for some of the sectors, including tourism. We are confident, and we have measured, based on transactions, based on consumption, the most recent data that we have in our hands, we can testify that the horizontal measures that have already been taken, which is, as you see here, the first total 12 billion, which is in the middle of the page, have started having some material impact. And the program is now going to be ramped up to 24 billion. The fourth point has to do, okay, fine, we have measures, and the program is 24 billion. Do we have the money to back it up? And if we need to back it up, what is the implication to other needs for the state? E.g., tax reliefs, additional, e.g., public investment program. The answer is that it is tight, but we don't have a problem. Let me elaborate. In the middle, you see the 24 billion of the cost of programs. On the left-hand side, the cost of the different measures, where do they come from? And on the right-hand side, how these are funded. So you have 10 billion for the measures that have already been announced, the horizontal ones. 7 billion is the new measure, primarily sector-based, and the sector state guarantee loan program, which is the 2 billion plus the 5 that is going to be the leverage from the banks. That's the total of 24. And this is covered 5 billion from the bank leverage, 14 billion from EU and ESPA funds and some borrowing. For the moment, the split between this is 11 and 3. And finally, you have 5 billion of the program being covered by cash reserves. So the next point is, do we have this 5 billion that needs to be covered by cash reserves? The answer is yes, we have it. Before we started this whole journey, we had approximately 28 to 30 billion euros as a starting cash reserve position. We take out 16. 16 is the ESM buffer. It cannot be touched. We take also 4 to 6 billion, which is going to be for the year, the fiscal impact of the lost revenue. Then you take out the 5 billion that we discussed before, which has to do with the part of the measures that were financed by the reserves, and we end up having also a small buffer at the very end.
George, you mentioned 5 billion leverage from the banks. Can you explain to us where the sources of this 5 billion leverage for the banks will come from?
The state is putting 2 billion, and there is a program that the banks are going to be putting up to 80% of the loan as guarantee, with an average of 40% for their portfolio, which means that the banks will need to underwrite the remaining. This is going to be based upon the banks underwriting and understanding of where it is best for them and the economy to underwrite additional loans.
Thank you very much, George. I intervened because obviously there is always concern about the status of the bank, and the way you describe it seems they all have a capital in excess of the specific, let's say, limit. Thank you.
So, closing, I don't feel bad about Greece. I feel okay, because I think that the recession will be smaller, because I think that the banking sector is robust, because I understand that there is an important set of measures that have impact in terms of economic sectors that have been hit, and I understand that we can fund the program of 24 billion. Thanks a lot, guys.
George, if you would like to take off your screen.
Sure. That's a good point.
I would like to thank you. You gave a very optimistic perspective of the next years for the Greek economy, and you justified concretely a lot of your numbers, specific when it came into the reserves and to the bank, let's say, support. I would like to ask the attendees, and we're getting a lot, if they have any specific questions, we have a question and answer section where they can send me the questions. And now I would like to go to the head of the Boston Consulting Group, Vassilis Antoniades, to give us the perspective of the Boston Consulting Group for the Greek economy and specific industries in Greece. Thank you, Vassilis.
Elio, thank you very much. I really appreciate the invitation, and it's a great honor to be presenting with you, George, Luigi, to all the fellow alumni. I would like to start with one skepticism around the state of the world, but also share and build on the optimism of George about Greece. One thing that concerns me a lot is that despite the improved forecast that we see on the global economy, and I'm not going to bombard you with numbers, but I have highlighted one set of estimates from our institute that concerns me a lot, and this is the middle column that has to do with the impact on employment around the major economies globally, seeing that for most of the major economies. Over 20% of employment is being impacted, meaning either unemployed or employees that are furloughed or in employment measures. And I will come back to this at the end because I think this is the biggest challenge that we are not addressing globally, and I think it will be a source of polarization and also risk of further wave of populism that we might see if we do not address right. And this is just something about the world. When it comes to Greece, as I said, I also share the optimism, and the government started with the left scenario of the fast recovery, which in the beginning we thought it's going to be very optimistic because of the length of the confinement, which seemed to be very fast. But it looks more and more that we might be going for a relatively fast recovery. Our view is that we will not exceed the 10% contraction in 2020, and we will be able to have a recovery of around 6% in 2021. This is, of course, provided that we will continue in the same pace as we have seen the opening up of the economy, and we will not have a second hit of COVID that will severely impact our economy on the fourth quarter, which will lead to the more profound recession scenario. So we are somewhere between the fast recovery and the delayed cure. If you asked me 2 weeks ago, I would have told you that we are expecting a decline of the GDP of around 10%. Now I'm more towards the 7% area because of the measures and because the optimism, especially around the tourism season and how we might also be getting external boost to our GDP, especially from July onward. I would like to focus on two other sectors, and the reason is that both energy and shipping in their own way contribute to our GDP. Energy, because of what you said in the very beginning, we need gross fixed investment, and this is a sector that can contribute north of 8 billion over the next 2 to 3 years in foreign investment, privatization, revenues that will come from privatization that will further help to the state finances, to what George was showing. Shipping, because it is a sector that we tend to forget sometimes. We speak of the importance of tourism being 20% of the GDP. We forget that shipping is, depending, of course, on the year, but no less than 12% of the GDP. And it is a sector that faces mixed signals because of the COVID crisis, but for sure has some silver linings, and definitely in the tankers, which is the most important segment of shipping, some very positive news. In energy, I agree, the demand dropped by 10%. We have less dependency on industrial consumption, but for sure there was a drop that we saw in the economy, which we expect to be around 10%. Gas, on the other hand, and this is the peculiarity of Greece, the consumption will increase because we are going through a gasification process. And another thing that I know there has been a lot of opinions, and I don't know if Stefanos Manos is on the call, he has written a lot. The system marginal price is increasing, which is helping in the competitiveness of the industry as well. What gives me a lot of hope on energy is that we see no less than 6 privatizations that are on the way, both on infrastructure, but also DEPA commercial, which are assets that are highly seeked upon both by strategic investors, but also private equity funds. We have local investors that are very active and are part of the solution. And we also have significant interest that has already been shown from DEPA infrastructure, DEPA commercial, etc., from significant private equity funds. What this means for our economy, and this is very important to your point, Stelio, around the need for gross fixed investment, is that we are expecting that if the government doesn't blink and continues on the privatization program, which is bold, but certainly feasible, despite COVID, it will be no less than 8 billion of investments in the next 2 to 3 years. The EastMed pipeline could add further to that. And if we proceed full-fledged on the national green transition program, we could also be seeing flow of funds north of 20 billion. And as I said, this is something that is feasible because of the quality of the assets and also because of the relative better state of the economy in those sectors, electricity, gas, and so on. What is also very important is that this privatization and this attraction of foreign investment will also transform key regions in our country, like Western Macedonia, that will move from a lignite landscape to a natural gas with CCGTs and renewables, and also leveraging better agriculture and tourism, and the same thing for Megalopoli. And again, this could be role models not only for Greece, but also for Europe. Further to this is that we see that Greece could become a role model, as the Prime Minister and his government have put on the agenda from the very beginning of the tenure around reducing CO2 emissions that cost significant money to PPC, but also to the country overall, to not only the economic, but the social development of key regions in the country, and also to make Macedonia and the Peloponnese examples for further development on the green economy in our country. I want to go to shipping, and being conscious of time, I'm going a little bit fast, because as I said, it is 13% of the GDP. We see the tankers being the main segment, being impacted positively because of the unfortunate situation with the oil and the contango, but given that many of them are serving as storage, definitely in the short term there has been a positive impact, and we also see that this can carry on in the midterm. Dry bulk, which is severely impacted by China, had a very bad hit in the short term. What we believe that with the bounce back of China, but also the global economy, it will improve. And containers has been the one that has been also quite badly hit, but again, highly dependent on international trade. We see a potential bounce back relatively soon. I think many of the attendees coming from the shipping sector will recognize the numbers and the significant uptick that we see on the tanker rates, but not so much in the bulkers and the containers. I want to say that this is good news for a good part of our shipping industry and the role that it plays not only in the industry itself, but also as investors in the country. So my message is that above and beyond the government support and all the state measures that we are talking about, we need to look at the organic sources of investment, gross fixed investment, but also beyond that are there and we should not ignore. And for me, this is very important because I hear a lot of voices for state aid. And unfortunately for our country, state aid, there was always an argumentation on why it will help on its competitiveness. I think long term it has not happened, and we should not ignore the importance of privatization and foreign direct investment as key sources of growth. I want to conclude with first a positive message around the global economy and how we see consumer sentiment coming back in all major economies. In Greece, it never really dropped as low as in other countries, but we see that also in many major economies it's coming back. But also on this skepticism and problematic around the future of employment, because we see that there is a lot of discussion in companies how we should be going for more flexible working setups. But I think that what is very important is to see how we accommodate all the challenges that we see around employment that is being impacted more severely than anything else in this crisis. And as I said, it could certainly have social and eventually political implications and a comeback of populism that we do not want to see. So with this, I stop and ready to take any questions.
Thank you, Vassili. That was very, very informative and very constructive, because we saw a lot of the prospects that would make sense for Greece for the next years. I would like to start with few of the questions that have arrived. The first from Miranda Xafa goes to George Tsopelas. In your view, is there room for tax cuts in Greece after the virus-related emergency spending? Is there room for spending cuts? George.
Can I show something?
Please.
This is what is legislated and what is discussed. The legislated in terms of corporate income tax that has gone down from 28 to 24. On the left-hand side, you have all the tax measures that have already been legislated, and these are going to be implemented. These are going to be implemented. On the right-hand side, you have some temporary measures that have just been announced, which have to do with a number of different measures for the employment, for the accommodation, for travel. And then you have the middle column with some other things that were part of the agenda in terms of dropping the corporate tax rate down to 20%, reducing the personal income tax to 42%, take out the solidarity tax. No, anyone can have an opinion on that. If you ask my personal opinion, I find it challenging to find a way to do that in the short term. But the left-hand side, which is what is legislated, plus temporary measures, are a reality.
Excellent, thank you. George, can you take off the screen, please? Now, the following question came from Alexandros Benos. How may the creation of a bad bank, an issue widely discussed these days, affect the health of the Greek banking sector? I would like Vassilis Antoniades to address that.
Thank you very much, Stelion. Thank you, Alexander, for the question. On the systemic bad bank, I am a big proponent for two reasons. First, because I think that the Hercules program was certainly a great step, but it was pre-COVID. So I think we need more measures. And the reason why I'm a proponent of the systemic bad bank is that it is something that in the previous financial crisis was certainly part of the solution in Ireland and Spain, that both in terms of banking, but also the real economy, were able to address the NPL issues much better. Italy and Greece, that did not follow the systemic bad bank approach, and when they considered it, it was too late. And in Italy, that it was implemented, it was a little bit mixed up, dragged and kicked the can down the road a little bit too long. I'm not saying it should be instead of, I'm saying it should be on top of. The one thing I want to add on the banking sector, I agree with George that we have, from a sustainability and capital adequacy perspective, a robust banking sector, But from an efficiency perspective, if you look at the cost to income, we estimate as BCG that there is no less than 300 million of additional cost pre-COVID that should be taken out, which now, in terms of the pressure that we see on the top line, and of course the additional cost of risk, which will not be significant, will still need to be taken out. We believe it can be done organically, and it is too premature to discuss about further consolidation because the market has consolidated significantly already, but it is also a part of the picture that we should not forget. Yes, capital adequacy is strong. Yes, NPLs, we don't see a significant blitz, but efficiency for its long-term sustainability is important, and there is still a lot that should be done there.
The next question comes from Nicholas Vassilis from London. He says that from the current debt to GDP ratio of 178, we will fast approach the 200 in 2020. Can this be sustainable, especially when the country does not have its own currency? And what is the solution there? This I would like to be addressed, if it's possible, by Luigi Buttiglione and also Vassilis, if he wants to help.
You're speaking about Greece?
Correct.
Well, Greece has the advantage that they had a crisis already. So there was a restructuring of debt already. So I would say that although it's definitely extremely high, of course, in terms of debt to GDP, the restructuring has occurred already. So I would say I'm much more, and to be honest with you, although I'm definitely more pessimistic, and probably both Vassilis and Georgia globally, I would say I'm equally optimistic about the Greek outlook because the crisis is behind, the restructuring has occurred, there is a new government. I would say the human capital of Greece is back to work, something which I cannot say for instance, about my country. Quite likely I expect that to GDP to increase in Greece because of what's going on. But I would say because of the restructuring which has already occurred, I'm definitely much less worried about debt to GDP in Greece than I am about debt to GDP, say, in Italy.
Excellent.
And I think that's the main concern I would have in the euro.
Vassilis, would you like to add something on this?
No more debt, as little state aid as possible. And the reason why I'm saying this is because, as we saw, there is sources of bringing foreign capital, sources of privatizing, and I've only shown one example. I didn't discuss about the airport, which is a significant privatization. I didn't discuss about infrastructure in ports, etc., which are further levers of attracting foreign capital and privatizing and avoiding debt. Debt has not helped Greece. State aid has maybe some purpose in some sectors, but it has also historically never helped Greece either.
The next question is from Paris Delianakis. What is the opportunity cost of not directing the 14 billion of ESPA EU funds to other investments? And I would like George Tsopelas to address it.
$14 billion is the amount of the combined borrowing plus ESPA. 3 is the borrowing. 14 minus 3 is 11. Out of the 11, the 4 were unabsorbed funds, and the remaining 7 were dedicated funds for the COVID-related. They are the programs that have to do with the stimulation of employment, stimulation of liquidity for SMEs, and so on and so forth. So out of the 14, relevant for EU is 11. Out of the 11, 4 are there, and the 7 are for this purpose. So the question essentially is what happens with the opportunity cost of the 4? And the opportunity cost of the 4 for 2020 is very low because they were unabsorbed anyway. For 2021, we have the hope that a bigger part of that will be able to be absorbed, and there will be less need for that for the stimulation program. So it's an issue, but I don't think it's a big issue. Can I say something about the debt? Because I fully agree with Luigi and Vassilis. I want to take one step earlier. Are we going to create new level of debt or not? This relates to what will happen to the budget deficit. We discussed before, and I showed that we are not facing a liquidity issue, but then there is a question: what is happening at the level of the fiscal deficit? And the answer is the following: last year we had 7 billion of deficit, of surplus in our fiscal surplus. This year now we need to take out of that 8 billion, which is the net cost of the measures up until now from the 24. The net cost for us that are fiscal related is around 8. Then you had another 4 to 6 billion of lost revenue. So you end up with a deficit for 2020 of around 5 billion. So you are looking at a real deficit going from 3.5% of GDP down to 2.5% of GDP. And remember something else also, that according to the EU, no support is taken into account and no lost revenue is taken into account if it is coming from the COVID. Therefore, in the books, in the papers, Greece will maintain its budget surplus of 3.5. In reality, we will have a deficit of 2.5, which is around 5 billion. This is going to be the need for new financing. So it's not a big thing. We cannot hear you, Stel.
Yeah, I apologize. I have the following question from our fellow HBS alumni Theodorism Gidis. Should we be thinking in percentage change of GDP, or should we be thinking of GDP projections versus GDP potential? Given the natural potential is higher and the disruption has been exogenous, which way should we be thinking? Vassilis Antoniades.
I agree. The problem is that if we look at what would be the GDP potential given the trajectory of growth that we were in, and we compare it with the actual development, I think for Greece it would show a much bleaker picture, because we were projecting that we would be north of 2% in terms of growth in 2020, and we are discussing whether the decline is going to be 7, 8, or 9%, depending on where you go in the estimates that we showed. So it would mean that the delta is close to 10%, unfortunately. So I don't think it would be a very favorable picture for Greece, if I understood the question directly. So yes, it's true that, you know, in terms of the potential GDP, things are quite, I would say, hit.
Okay. Now, there is a question from John Ganos. What are the implications in the Greek real estate markets on rent and capital values, taking into consideration there has been a massive repricing over the 10 years financial crisis? What are the prospects for the coming years? George, I can help you on that, but address it. I don't want to be very subjective.
Please go ahead. Go ahead. You know real estate much better than me.
Okay. What we see basically in real estate is that there has been a lot of negative effect on retail, and particularly in shopping malls. But we saw a positive sign for logistics, given the increase of e-commerce, and we are having a short-term impact for offices and potential for the residential sector. But this should be short-term, and which will last for the next most probably 2 to 3 years. And then we see a recovery coming back to not to the original prices, but at least closer to the 2019 levels. I would like to go now to a very interesting question by Kostas Dimitriou. Away from the macro and more towards the micro, from the perspective of the investors, which sectors do you see as the best opportunities during this crisis? This question, Luigi, do you want to address on a general level this, and then we can go in more specifics? Which are the opportunities in which sectors?
Well, I would say that I would share what has happened in the equity market in the last month or so. The equity market has taken a very sanguine view across sectors. So, and frankly, it's difficult to disagree with that. So basically the sector which has done well have been logistics, high tech, pharma, food related, and this is of course against those who have to do more with retailing, which have been the worst performers, transportation, tourism related. It is difficult to disagree with this view. There are really winners and losers in the current situation. Of course, nothing is forever, but it is difficult to disagree with the view.
I would like to a specific question for you, Luigi, from Alexander Makridis. In your opinion, who is a fellow Harvard Business School graduate, in your opinion, during the crisis, Germany, politicians elected will finally make the quantum leap and accept some of the mutualization of debt that will have a meaningful impact on the economic and political cohesion of Europe. Interesting question.
So the question, sorry, if there will be because I think unfortunately
how likely is that during this crisis the German politicians and electorate will finally make a move to accept debt mutualization?
I think it's difficult. That I see there is a lot of optimism spurred by what Merkel said yesterday with Macron, and a good deal of people saw in that really an embryo of common fiscal policy, Eurobond, shared fiscal action. I personally disagree with that view. I think it's we are still very far away from this kind of situation. I think Germany is also a country which is led by rules. I would say rightly so. So for them, rather than doing something and then doing the rules, I think what they would do, they would rather do the rules first and then comply with them. For the time being, the rules are that there is no fiscal union in the Eurozone. So, and this is a pity, which goes to the beginning. So it's really something which should have been done from the beginning, and it was not done. But I think, as Merkel said, they want to comply with the treaty, and both on the fiscal side and the monetary side. So no monetary financing, no fiscal union means that you have limitations what to do. So I would not have that much of hopes in that direction.
Okay. Given that we always tend to be punctual and prompt at the Harvard Business School culture, it's 7:36, and I promise that by 7:30 we will try to conclude the session. I thought it was very constructive, very helpful, very informative. I would like to help very much the panelists for their input, feedback, and intellectual support. I would like to help the participants for joining in and making this and adding a lot of added value. Thank you a lot.
Thank you very much.
I would like to add one more thing, that in June, we will have the Prime Minister of Australia, Kevin Rudd, the biggest expert in US-Chinese relations, as a guest of Harvard Business School to address the US-China relations. He's the biggest interlocutor between President Xi and President Trump. I would like to thank you all, and I wish you safe, healthy, productive, and constructive lives. Thank you very much. Thank you.
Thank you very much. Thank you.
Thank you.